Hi everyone, my name is Ben. Welcome to the channel where I find you investment ideas that grow and protect your wealth. A good investment vehicle to give you fast, diversified exposure to a market is an exchange-traded fund or an ETF. They are also great products for investors that do not have the time to pick a great stock or are not interested in stock selection and taking on company-specific risks, which is really a lot of investors. People may be too busy with other time-demanding commitments in their lives. An ETF might be a product for these investors looking to use sector exposure only for outsized market gains. Due mostly to this chart of commodities trading relatively low to stocks, and maybe a good time to overweight commodity stocks in your portfolio. It looks like commodities are an underinvested asset class that has not outperformed the stock market since 2008, where the run in the last commodity boom ended. Gold, copper, and oil all outperformed the stock market and had incredible moves higher. And it looks like commodities are overdue for a strong relative performance to the stock market. A great ETF to get exposure to gold miners is ticker symbol XGD, or iShares Global Gold Index, which trades on the Toronto Stock Exchange. This ETF has fared decently well compared to the commodity stock ratio chart. XGD has a stellar one-year performance, up 64%. The 10-year performance falls more in line with expectations of a long-term bear market in commodities, with a gain of just 9%. It looks like gold is leading the charge of the commodity stocks this time with the recent yearly outperformance. XGD does pay a small dividend of about 0.72%. The management expense ratio is 0.61%. The top holdings include heavyweights like Agnico Eagle, who are considered one of the best mining operators in the world, and other great companies like Wheaton Precious Metals and Barrick Gold. The next ETF is ZEO, the BMO Equal Weight Oil and Gas Index. It will give you diversified exposure to oil, gas, and pipeline stocks. The one-year performance is up about 15%, and the 10-year return is an increase of just 5.8%. These returns are more in line with our first chart of the commodity stock ratio. The current distribution of ZEO is an attractive 3.7%, and the management expense ratio is 0.6%. Pipeline company Enbridge, integrated oil company Imperial Oil, and Canadian Natural Resources are included in the top 10 holdings, a nice mix of oil, gas, and pipeline companies. The last ETF on our list is iShares Global Base Metals Index ETF, ticker symbol XBM. The one-year return is 8.7%, and the 10-year gain is just 6.9%. The ETF pays a distribution of 1.35%. The management expense ratio is again 0.6%. Top holdings include giants Rio Tinto, BHP, and Teck Resources. You can see the returns over the last 10 years have not been great in the commodity stock sector, but I think that will change in the near future. Commodities are set up to outperform the market. I think there is a bull-bear case to be made for investing in ETFs instead of individual stocks. The bull side is ETFs are great for new investors that may be skittish about investing or are not interested in trying to pick stocks that are going to outperform. ETFs also benefit from investors who only have a small amount of money they want to invest. Even with a small amount, investors can get diversified exposure to a sector. Lastly, with one buy, you get diversification in the sector, taking out a lot of the company-specific risk. On the bear side, you will end up with exposure in companies that you might not like. These products simply just give exposure to a sector. Also, in these particular ETFs, you don't get any small cap exposure mixed into the group. Lastly, there is a management fee that is ongoing that you must pay. That's it for now. This is not financial advice. Please do your own due diligence. Thanks for watching, and we'll see you in the next one.